Hello, and welcome to the latest episode of the Friends of Sanctuary podcast. I'm Marianne Bartels, Chief Investment Strategist at Sanctuary Wealth. Today, I'm pleased to welcome our guest, Bob Long, CEO of StepStone Private Wealth, and our very own Patrick McGowan, Head of Manager Research and Alternative Investments at Sanctuary Wealth. Bob and Patrick, thank you so much for joining me here today.
My pleasure.
You know, we're moving into the holiday season, Bob, and there's going to be a lot of people looking at Christmas trees, evergreens. When I hear evergreen, I think of a Christmas tree. But Wall Street has renamed evergreens, and they're called evergreen funds. Can you tell our listeners and our viewers what is an evergreen fund in your world?
An evergreen fund is simply a mutual fund for private assets. This is the way for individual investors to access the private markets in a manner that is more convenient, efficient, and transparent. Historically, if you wanted to invest in private assets, you committed to a drawdown fund, a traditional drawdown fund. You made a commitment. That capital was called from you, drawn down unpredictably over a 3 to 6 year period, and returned to you over another 3 to 6 year period unpredictably. There was a K-1 involved. The minimums were $250,000 at the low end, and you had to be a qualified purchaser, an investor with $5 million or more of investable assets. Evergreen funds have made this much easier. They are very much like mutual funds. In fact, they're regulated like mutual funds. They take capital in continuously on a daily or a monthly basis. You get immediately invested. There's no unpredictability of capital calls and distributions. The minimums are quite low as $10,000 for some of our funds. The typical minimums are about $50,000. And instead of getting the dreaded K-1 in October, causing you to have to file an extension for your tax return, you get a 1099 in January, and you can put these in your IRA. So they really are the convenience mechanism, the convenient way for individual investors to access the private markets.
So the word that I keep hearing is that this is the democratization of the private markets. Is that correct? Where individual investors have easier access to your funds.
That's true, but I'll take a view that's a little controversial in our industry, or at least a little different. I think we're in the institutionalization of democratization. There were early forays into this retailization or expanding access. And frankly, many of those products, and Patrick knows well, he was in the industry and researching these, they weren't truly institutional caliber. But what you see from us and our high-quality peers that are on the Sanctuary platform are the same investments that the institutions are making at the same price, at the same time, at about the same fees. And so what you're really seeing today is individuals getting access to that same content, not a diluted or differentiated or special set of deals for individual investors.
So Patrick, you spend most of your days evaluating different products, a lot of them on the alternative platform, private markets. You do a lot of work on the evergreen funds. Can you explain what you're looking for? What kind of constitutes a product that you think is investable, at least for our client base?
Yeah. So one thing that we just touched on, I think Bob highlighted, is we're looking for funds that look very similar to what an institution would get. So when you take a institutional investor and you're looking at you take away a concept of an evergreen structure, and you look at what's inside of the funds that they're investing in, it's individual companies that the best top tier managers or consultants have access to. Then we say, we want those same exact deals. And so that's where we start. We meet with the manager, we say, does this asset manager have the ability to give us the same deals that they're giving to their institutions? And the only thing we want in the experience for our clients is what Bob highlighted, is all of that in a wrapper that's easier to purchase, that has an easier tax filing. It has some liquidity we have some control over what the certainty and frequency of that is. and have transparency around what's inside the portfolio and how the valuations are happening. So we sort of have the best of both worlds. And I think it's even sort of waking up the institutional community that some of these products are as good. And we look at all those things, and not every evergreen fund that comes out checks all those boxes. So it's our role here to kind of look through everything that's out there and make sense of it all.
Well, obviously, we're friends of StepStone.
Yeah.
So, Bob, when you're
We consider that an honor.
yeah, well, thank you. You sit down with clients, with retail clients. What are some of the questions that they're asking you? And maybe what are some of the questions they should be asking you that
Right.
they're not asking you?
The question that they ask us is allocation policy. This builds on what we talked about earlier. So StepStone is primarily an institutional firm. We're one of the largest allocators to the private markets globally. We're $700 billion of assets we're responsible for, putting out $70 billion a year. We're a big player. Not much moves in the global private markets that we're not involved in or don't see. So we have about 150 large institutional clients. Our investors want to know they're getting the same deals at the same price at the same time. And so when I brought the team to StepStone, we started this business 5 years ago, core to that was that StepStone's DNA was already a pro rata allocation. So if you happen to be the sovereign wealth fund of Japan and you're a client, and SPRIM, our core private equity fund, is investing in the same deal, a fund that's available on Sanctuary and has been for a while, you get a pro rata piece based on an annual allocation budget. So the takeaway is same deals, same price, same time. And the question they should ask is the follow-on. How do I know I'm not adversely selected? How do I know that I'm not getting deals that institutions didn't want? And the answer to that, it starts with the allocation policy. The second piece is the Securities and Exchange Commission is very interested in that issue. And in fact, they have very specific guidance and very specific procedures that we and our high-quality peers follow that's governed by and examined by an independent board of directors. That's just like an independent mutual fund board. It is an independent mutual fund board. So pro rata allocation policy, make sure you're not adversely selected. Those are the questions that people really should be asking us. Many do. Obviously, manager research does at firms like Sanctuary, but many individual clients also ask us that.
So, Bob, I spent many years in research at Merrill Lynch, which is now part of Bank of America. And I used to talk to a number of industry analysts. And many analysts used to say it was important to know the management team, right? They may be in a great business, but very important to know the management team. You brought together a great group of individuals that had phenomenal experience on Wall Street. Why don't you explain to our viewers the pedigree of what StepStone is actually bringing?
Well, thank you. And that's flattering. Thank you. Frankly, the thing I'm proudest about is our team and my three co-founders. So this was hatched. My colleague, Tom Sinema, who ran a very large retail platform, and before that, the real estate investment bank for Bank of America. I'm also a Bank of America veteran, as you may know. We got together in early 2018, and we had a vision that the world needed more convenient, efficient, transparent access to institutional caliber private markets. And Tom was leaving his post at a firm he had built. I was available. We got together. We thought we had similar and complementary skills. And then we brought in Neil Menard, who is our head of distribution, president of sales globally, and then Tim Smith, our COO, CFO. So the four of us have been in this industry for quite some time. We've led large organizations. I've been the CEO of a public company, a traded company, a couple of times, so I know what that's like. Tom has run very large platforms, as have Neil and Tim. So that's our management team. And then we brought this idea to StepStone, who'd been serving institutions and was keen to offer what they do to individuals, but wanted a dedicated team that really knew how to navigate the special needs of individual investors. And we'll get to some of that, I'm sure. Things like individual investors find a small amount of paperwork very troublesome. I get that. By the way, the punchline of this industry is convenience wins. That's the punchline. Institutions didn't really care about filling out a 50-page subscription agreement. They had lawyers for that. Your clients don't have lawyers for that. Institutions didn't care about a K-1. By the way, a lot of them are nonprofits or don't pay taxes. They didn't care about a K-1 in October. They didn't care about getting their valuations 90 to 120 days later. Individuals want to see things on their statement. They want a 1099. They want to know what it's worth. Their financial advisor wants to know what it's worth. So we really put those at the forefront of designing our business. And frankly, I think it's what's helped us succeed.
Patrick, the wealth management industry, meaning basically individual investors, really haven't added much of the private markets in their portfolios. This is kind of a new investment structure for them. Why do you think it's important for an advisor and for that client to really consider putting the private market in part of their asset allocation in their portfolio?
So there's several ways to think about this, but one way that I like to think about it is when you take away, every manager and their ability to, to sort of outperform. I think that's important, and that's part of the manager selection process. But when you boil it down, I think you have to look at some of the big numbers, like the amount of companies or the amount of sort of assets, whether it's credit or equity, that are just in the private markets that you don't get access to if you're only in the public markets. And so in the public markets, if you look at companies in the public markets that are over $100 million of revenue, there's only 13% of the companies in the US that are actually public. So the remainder are, the 87 roughly percent are completely off limits. And within the public market arena, we know it's concentrated to a very few number of names that really move that. And so when one of the sort of basic tools that we want to make sure we remember is that diversification is one of the free lunches that's out there. So you are able to, you don't want to buy every single private company that's out there, or be involved in a loan that a private company is getting to all of them. So you do want to be selective and actively play in that space. And it's really hard for managers to, for any single one manager to have access to a broad swath of private companies. And so that's why firms like StepStone that see a lot of opportunities across every manager that they work with, or are directly getting investment opportunities brought to them, can really build a diversified portfolio. And so I think of it less as, think more of it as an opportunity just to get exposure to an asset or two assets that are traditionally off limits to them. And it gives you diversification, generally gives you therefore lower volatility in the portfolio. It gives you a variety of benefits that you just normally don't get if you're only doing public market investing.
Patrick, why don't you talk about, there are so many companies today that are not going public.
Yeah.
In fact, 20 years ago, we had over 5,000 stocks listed on the New York Stock Exchange, and that's down to 2,000 plus. There's been a dramatic shift where companies are staying in the private market longer. Is that another reason maybe to consider? Why don't you talk about the lack of public companies and that people really should consider the private markets because that's where those companies are and they're growing.
Right. It's when you look at some of the market cap of companies that will be shocking when you look at the size of the market cap of companies when they IPO'd back in the 90s and 80s. They're in the tens of.
We actually remember that. We know you don't, but we do.
And you look at companies that we might talk about today, and they're really hard to access. But you have companies like, I'll throw out like a SpaceX that a lot of people have heard about that is continuing to fundraise, and they generally have sort of more and more capital available to them to continue their life in the private markets. And I think that traditionally a company would go public for that access to capital so that they could grow, so they could do the next stage of M&A, the next stage of growth. But you see that as these companies realize they don't have to have the scrutiny of the of expectations around Wall Street and the volatility of their stock price affecting the company itself and the morale of the company, they say, let's just stay private because we have a vision. Our CEO or our firm and our team has a vision that we want to continue to work on and build. And it shows you, I think that's partly part of the reason why the private markets outperform the public markets by 300 to 500 basis points historically over time. And it also gives the companies the opportunity to work privately. It also gives the private equity firms that are investing in those companies the opportunity to, have a value creation plan or continue to do things with that company that they could not do in the public markets.
Bob, do you want to talk about that? Because
Yeah.
obviously you have some market history,
I did.
as well as I do. How the structure of raising funds for companies has changed.
And let me first tag on to something Patrick said. I've been in the markets for quite a while. And the reason people seek the private markets today, or financial advisors put their clients in funds like ours, because they're seeking growth. And you know what Willie Sutton said about the banks? He went there because that's where the money is. Well, if you want growth, you really need to look hard at the private markets. And private companies, institutionally backed private companies, are growing revenue, not just bottom line, but revenue, 4% per year or more than public companies. So if you want growth in your portfolio, it's really hard not to consider
That's
the
a
private
very good
markets.
point.
And that's changed a lot in our careers. So companies are staying private longer today for a variety of reasons. First of all, Sarbanes-Oxley has made it very expensive and time-consuming for management teams to simply manage the process of being public. As I mentioned, I've been a publicly traded CEO of a publicly traded company, both in Europe and in the United States. And the pressure of quarterly earnings, the filings, the compliance is quite meaningful. So you don't go public unless you need to go public. You mentioned SpaceX. Historically, companies had to go public if their business plan required a tremendous amount of capital. What could be more capital intensive than building rocket ships? But yet SpaceX has not gone public. SpaceX is in our portfolio. It's raised a dozen or more rounds of private financing. As far as I know, it has no intention or need to go public. But that is it's one example, but I think it's a great example of why an entrepreneurial management team, even one whose business plan requires vast amounts of capital, does not have to access the public markets. So that's a complete change. 30 years ago, you couldn't have built a $20 billion enterprise or raised, many of these enterprises are valued at more than that, but raised $20 billion from the private markets. They weren't deep enough. But today they are deep enough, they are specialized, and a number of structures have arisen, including evergreen funds, that have just made these markets more accessible to a broader base of people investing, allowing the general partners who's in between to make bigger and larger investments. So it's dramatically changed. In fact, some have argued that the public and private markets have largely changed places. So you alluded to the Magnificent Seven. I think most of us are familiar with their disproportionate impact on the public markets, both being a third or so of the market cap and having vast impact on actual returns year over year. We're all familiar with that. Well, the public markets now are highlighted by the sexy sectors, for lack of a better word. I've been trying to come up with a better word, have not. The sexy, high-profile spotlight sectors like tech, whereas the private markets are financing the bread and butter economy. You mentioned 87% of companies in the United States that are real, that are sizable, 100 million of revenue. So not my personal LLC or your personal LLC. Big companies, 87% are private, and that trend is not going in the other direction. So if you want to participate in the bread and butter industrials, healthcare, business services companies, you really need to think about the private markets. That's a big change over the last, particularly since the global financial crisis.
So clients and advisors really consider, I think these are very compelling arguments of why you should really be looking at the private markets. Bob, you and your partners started a database. It's probably grown bigger than you probably even expected, but I hear it's an extensive, comprehensive database of information on the private markets. What does that give you and your partners? Does it give you a competitive advantage? Because you're having data on or access to data that most people don't have access to. Because someone or a group of people were brilliant in saying, maybe we should track this information, and now you have it. So how are you using it to your advantage?
By definition, the private markets are opaque. There is no Bloomberg for the private markets, although we think we've built one called StepStone Private Intelligence, conveniently shortened to SPY. StepStone Private Intelligence. We track 230,000 different investments in that database. We believe it's the most comprehensive in the world, and it is proprietary to us. We built it. What it allows us to do is to spot trends early and quickly. It allows us to evaluate new opportunities and quickly focus on the ones that have the highest potential. Life is about what you focus on. And our ability to separate the potentially great deals from those that are unlikely to be successful is just really accelerated by this database that's on the desktop of all of our professionals and, in fact, a number of our clients. So it helps us spot trends earlier, act on them, separate good deals from bad deals, and just makes us much more efficient. In fact, we license this to some of the world's largest and most sophisticated institutions who want access to the database that we built.
So can you give us like an example or explain how you do like the research investment to actually select something to go into one of your evergreen funds?
So a classic, in the evergreen funds, we are primarily making direct co-investments alongside general partners that have historically had success in particular sectors. And we're buying funds and companies on the secondary market, typically at discounts. I know that's a big theme within your firm. You're very interested in the secondary trade. And so let's take a secondary. So state pension plan, North Carolina state pension plan, since I'm from North Carolina, decides to sell half dozen private equity funds because it needs liquidity. And so it comes to market with those funds. We know those funds. We know the state of North Carolina pension plan. And so we are a bidder for those funds. We underwrite, so let's say it's 6 funds, they have 20 companies each, 120 companies. We go in and underwrite each of those 120 companies and identify when we believe they will be sold and at what price. And then we sensitize that. So it's similar to the research you did as an equity analyst, but it's 120 companies. Then we come up with a bid for that asset. And so this database we have is what allows us to do that really efficiently and extract value and be a successful buyer of those assets, typically at substantial discounts to net asset value, which help drive the investment performance of our evergreen funds.
Now, Patrick, when you're looking at evergreen funds, can you kind of maybe walk us through the process you and your team go through in selecting what you think is a good evergreen investment?
So when we look at evergreen funds, we are first starting with the manager itself. And we want to make sure the manager itself has access to the right deal flow and the right opportunities, because that's ultimately what's going to go inside of the fund. So we look at that fund, we look at the manager, and we look at the assets that they want to invest in, the type of assets, and is it congruent with what we're looking for? And then secondarily, we look at the structure and determine if that's what we're looking for. Does it have the right sort of valuation policy? Does it have the right liquidity terms? Does it have everything we're looking for and the ability for that manager to invest? One thing I want to say that's that I touched on before about evergreen funds is one statistic that an evergreen fund that is doing a 3x return, so 3 times multiple over a 10-year period, can do that with an 11.6% return over that time, where an equivalent drawdown fund would need to do an 18% IRR to achieve that same return. So what that means is it's really hard to put a lot of investments at a continual basis into a fund all the time. Now, drawdown funds, they can wait and be patient and say, I'll wait till we find the right opportunity. Therefore, I don't really need to put as much effort out there or finding the right deals. We can be sort of slow and selective, which is good for them. But when you're looking at evergreen funds, which is, in our view, the best wrapper for our community for a variety of reasons we talked about, we have to make sure that the manager of that fund is sophisticated in finding those deals, or else you don't hit those returns. The other thing I will say is that you have to pick a manager that is very sophisticated, that has a very modernized way of running a private equity or private credit portfolio, and using tools at their disposal that maybe private equity funds in the past didn't have. So we were talking about secondaries, which is an important tool in the tool belt. We talked about companies are staying private longer. That also means private equity firms that only do drawdown funds at the end of the life of their fund have a little bit of a problem because those companies don't want to necessarily go public anymore. So the modern evergreen private equity or private credit manager knows that, and they have the tool to say, we can do a continuation vehicle. We can maybe in an evergreen fund we don't have to sell it at that time at a price that we may or may not want. It might be the right time, but it might not be the right time. And so there are not a lot of managers out there, while they have great track records and IRRs in the drawdown world, it requires a portfolio management skill that not everybody has the experience of doing. And so we push these managers to the limit to figure out if they have the ability to achieve those returns.
I've just learned so much in probably the last 30 minutes of the private market. Sign me up. Bob, you have an infrastructure fund.
Can I go back to this first?
Oh, sure can.
So a couple of things. Patrick did a great job of explaining something that's pretty nuanced, frankly. We have a paper that we can make available here to you and your clients. Maybe we could run it at the bottom of the podcast that gives the chart that he just quoted that shows how we round it. A 12% evergreen fund gives you the same spendable gain, multiple of invested capital, we call it, but investors just call it profits, as an 18% returning drawdown fund. And 18% returning fund is a very good fund. That is if you look at it against historical averages, 18% is a very good outcome. What I think investors might not fully appreciate is the industrial logic of compounding your capital. The reason a 12% over 10 years gets you to a 3x or an 18% gets you to a 3x is because in the drawdown fund, the 18% example, that's an IRR, the capital is coming and going. It's not staying fully invested. Now, we make assumptions that capital is invested in a broad equity index like the MSCI, but private equity is historically outreturned or outperformed. So point I'm trying to convey here is the simple industrial logic of compounding your gains. That is the magic of evergreen funds. That's why institutions are increasingly drawn to evergreen funds, not just individual investors who didn't want a K1. That's the sea change in our industry, is all kinds of investors recognizing the inefficiency of drawdown funds and pivoting toward evergreen funds.
That sounds like a major new innovation in the industry.
It is a massive secular trend that is only moving in one direction. Now, our white paper goes into what the benefits of drawdown funds are, because there are many. An evergreen fund is generally a broader strategy. A drawdown fund can be a narrower strategy. If you are an institution and you can really manage the cash flows, you get an unpredictable distribution back to you. You can instantly get it invested in the private markets because you're huge institutions, you have many funds. Drawdown funds are great. And there are other features of drawdown funds. But again, in our paper, I think we show a very balanced view of the pros and cons. What you're seeing at your platform and others, for individual investors, evergreen funds are just taking market share from drawdown funds in an expansive way, and that makes sense.
It makes a lot of sense to me as well. So one of the funds is infrastructure, and there's a lot of focus and talk about infrastructure.
Yes.
Why don't you tell us about your infrastructure fund?
Happy to. It's called Structure. The ticker symbol is STRUX, and on Sanctuary, that can be purchased with a ticker. You don't have any paperwork. It's available to accredited investors with a $25,000 minimum. The fund has been up and running about 15 months, and I'm really thrilled that the returns to date have been over 20% net. Of course, past is not prologue. You should consult a prospectus and talk to your financial advisor. So past results are not necessarily indicative of the future, but we're really thrilled with how that's worked. And the drivers of it are three trends: decarbonization, demographics, and digitization. Those are driving massive capital flows, private capital flows into infrastructure. In the United States, we're used to all of that being funded publicly. Well, if we were in Australia or Canada, this wouldn't be a new asset class we know about. But in the United States, we've been slower to have private capital fund that. So it's a big opportunity. Globally, we believe it's about a $4 trillion annual need for private capital. When was the last time you were in an airport that wasn't under construction? How many articles have you read about our crumbling infrastructure? So the government cannot fund that. Private capital is now organized in a way to do it. The other really interesting thing about structure is private infrastructure is less correlated to your other assets than anything else you could add. So let me say that differently. If you're a high net worth individual investor at Sanctuary and you've got a nice diversified portfolio, stocks, bonds, private equity, private credit, maybe some our venture capital funds, Spring, all of that, if you could add anything to it, the thing that would add the most diversification, or said differently, would zig the most when the market zags, go the other direction, is private infrastructure. And so we're very excited about the launch on Sanctuary, and we've seen tremendous demand for it.
Can you talk about digitization? Because
Yeah.
AI is big. It's expected to really grow substantially. We always hear about data centers. The demand for electricity. We've seen electricity demand grow for the first time in 20 years. I don't even know if any of this is in your fund.
It is.
But this is stuff that we're talking about with our clients. Can you talk about, because I think clients are just starting to understand that part of the economy.
So data centers is the sort of first order impact of AI. But there are others. The resiliency of the grid, transmission, battery storage. We did a really interesting battery storage deal in Australia, for example. There are many, many trends around this that are being driven by the need for infrastructure. You look at the geopolitical situation and the uncertainty. The world's as dangerous a place as I've seen in my adult life. Well, infrastructure protects your economy. And so the resiliency, the need to add resiliency and protections. There was a headline this week about a cable cut, I think in the North Sea, if I remember this right, a cable to Finland. All this stuff is generating the need for private capital to build resiliency and durability into our both information transmission system and our power transmission system, all of which, AI is part of that, but frankly, just a modernizing economy and a riskier geopolitical situation, all that's driving investments in infrastructure.
And I would add, just on the infrastructure theme, everything I agree with. For a long time, the largest alternative investment allocation in the high net worth world was real estate.
Yeah.
Which has a lot of similarities. Like, it has inflation protection, it's a hard asset, and it was really it was one of the few things that people were invested in that would, as Bob described, be a diversifier. But when you think about infrastructure, it has some interesting characteristics that are the same, but also infrastructure is definitely the groundwork that's kind of powering everything in the real estate segment, but also to your foreign data centers, which for a while were also in the real estate bucket. Now people realize you need a tremendous amount of energy, or a tremendous amount of water, or a tremendous amount of other resources to continue to fund those. And in infrastructure deals, for example, you'll have there, in a lot of cases, not all, but they can be very long duration. So sometimes they're 15, 30-year investment horizons that, again, would never be appropriate for an individual investor in the construct of a private fund, because a 30-year hold period is quite long. But they were really attractive assets. So having the ability to take those assets and put it into a fund like an evergreen fund is fantastic. The other thing I'll say is a lot of the infrastructure projects come with contractual sort of like, for example, like a power purchasing agreement, which is, if someone is essentially going to be building this infrastructure asset, they're guaranteeing that there's a certain amount of revenue that company is going to receive, or that project is going to receive, for delivering a certain amount of power to that community or that company. So there's a lot less risk when it comes to whether these underlying projects are going to generate revenue, whereas in real estate, we see a lot of like boom busts where, people vacate or they decide not to go to work anymore. This is very different. These are much more, I think, we believe to be more conservative, but also have very similar dynamics as on the real estate
And
side.
we see both at Sanctuary and our other close partnerships, a lot of investors rotating out of the evergreen real estate funds into evergreen infrastructure.
So one of the things I want to say is the digitalization of the world has been a very big theme for the past couple of years at Sanctuary. And to try to help clients to understand the economic impact and the sustainability of that impact, I use an example. If you would let me just give that example. Back in the 1500s, our technology was a sundial, right? Agriculture really drove our
I
economy.
barely remember that, but
I honestly don't remember that. I got that from the history books. But then we created the steam engine in the 1700s, and that completely shifted and altered our economy. Think about this, from 1500 to the 1700s, that's 200 years. We were agriculturally based. I argue we changed, I use 2000 because it's a nice round number, but it's really the 1990s. We really,
I do remember that.
you do remember that? So do I. We became digital. That's really when we became or started to develop the technology, and AI is just an extension of that. We didn't even talk about blockchain. Blockchain is going to be an extension of that. But think about the 1700s to 2000. I won't even use, that's 300 years. Right. So I don't think investors yet understand the sustainability and length of this theme and how this will build out over the many years to come. I just think that's important to kind of put in your back pocket to understand. When advisors want to access an evergreen fund, Patrick, how do they do that? And are there technology providers that assist them in doing that?
Yeah, so surveys have shown that most advisors, the survey we have, that half of investors plan to increase their allocation to the private markets in the next 12 months to some degree. And so there's a couple of ways to access it. In most of the cases that we're seeing today in our channel, they are in the evergreen format. So we're seeing we're seeing that expressed with certain structures like an interval fund. And another structure that, it's evergreen, you can buy with a ticker. You also have other strategies that might fall into something that's called like a tender offer fund, which is evergreen, has a 1099, just like an interval fund. But there are a few, maybe potentially a higher accreditation standard, but also paperwork, a very slimmed down subscription agreement that essentially makes that purchase a little bit more friction there, which might be good. I would say that when we think about making those allocation decisions, I definitely want to always bring it back to the assets first. So if somebody's investing in a fund, we want to look at inside of those assets and say, we want to invest, for example, in infrastructure. Great. When I add infrastructure assets into a portfolio, what kind of assets are they? Are they more digital focused? Are they more growth? Are they more income? And where does that fit inside of the client's need? And we will make that determination. And then from there, you'll look at the structures and go, well, as I'm looking to add these assets to a portfolio, I have some options here. I may want a fund that is for all investors that has 5% quarterly liquidity, and that might be good. Then I have an investor that may say, I'm actually a qualified client. Maybe I have a higher net worth, and I don't really need a liquidity. Maybe I can go down to, I don't need liquidity at all, but I'm willing to go down to some funds have like 2.5% semi-annual liquidity, whatever it may be. And so then you start to make the decision around combining the two together. And that's where our advisors really in the education curve is coming, where they're understanding both the assets they want to invest in to get the exposure in the whole portfolio, and then what kind of structure you want it to be. And it can be a little bit complicated at times, but essentially that's how we view it. It's no longer just allocation to alternatives as a bucket. It's really part of the whole portfolio. And so that's how they're accessing it now. And they're great because of the simplified tax form, the valuation process that we said usually has an independent oversight and has a lot of other balances that we prefer. which are great.
I think that's a really important point. I do think 20 years ago, advisors were thinking, well, I've got an alt bucket. But you're saying a good financial advisor is looking through that term. And by the way, we think of alts as a broad term that includes hedge funds, commodities, et cetera. What we do, and what we're talking about here today, are private markets, private equity, private credit, private real estate, private infrastructure, a subset of alternatives. But starting with the strategy, what you're investing in, is it debt? Is it equity? Is it inflation correlated or inflation protected like infrastructure as opposed to the structure? I think, again, back to the institutionalization. In some of these middle phases, advisors were saying, well, put my clients in interval funds. Well, that's the structure. What are you investing in? How's it going to behave? That's the right question to be asking.
Bob, what's the liquidity that you provide, right? Because I think that is a question that a lot of potential clients want to know is, can I get access to my money, or how long do I have to give you the money? So what are the liquidity structures on your platform?
So in an evergreen fund, you can enter daily or monthly. So it's continuously offered. Your exit is typically quarterly, and the typical liquidity is 5% of the fund. And by the way, again, that's of the fund, not of your investment, of the fund, on, in our case, just a few days notice period. So most of the time, most investors can get 100% of their capital out at 100% of net asset value with no transaction cost or legal fees or discount in most markets. Now, it's also true, and we want to make sure financial advisors are educating clients in this way, because we do not want investors that don't plan to be in this for a while. That's not good for us. It's not good for our other investors. It's absolutely true that these are not fully liquid. We are not magicians, right? So we're investing in illiquid assets to get the illiquidity premium of those assets, and we're offering 5% per quarter liquidity. In the event that 10% of our investors wanted to redeem, we've never had more than 1.5% want to redeem, but if we had another global financial crisis or a geopolitical event, that could happen. In fact, I'm sure in the next 20 years it will happen. Let's say 10% wanted liquidity. It's important for investors to understand. What that means is everyone who wants liquidity would get half of their money out at 100% of net asset value with no transaction cost. So they'd be prorated. They'd get half of their money out, and they'd be free to come back the next quarter. So that's how the liquidity works. In the funds on your platform, S-Prime, our core private equity fund, 5% per quarter liquidity. Structure Infrastructure Fund, 5% per quarter. Spring Venture Capital, that fund is 2.5% per quarter liquidity, because we do expect that to be a longer-term hold. That's our liquidity.
Bob, what I want you to explain, which I think is important for clients where this is a new structure for them. Why, when there's a crisis going on, why can I only get 50% of my money? I think what is important for them to understand is your assets. You can't just go out and sell your assets. It's not a public market. Can you kind of explain why that is so sticky?
Yes. So these companies are private. There's no public market for them. They can be sold in the secondary market, although that's a time-consuming process with a lot of friction, and that's our backup plan if the world just goes to heck.
But you can really lose, though, a lot of money, because you're going to wind up selling at a deep discount.
And so, again, the benefit of your experience comes through. So I think if you talk to the oldest, most sophisticated financial advisors at Sanctuary, they would say, I believe, clients never benefit from selling in a panic their illiquid assets. Time and time again has shown that. So look, the way we think about it, again, we're not magicians. This is not money that you are likely to need anytime soon. And you should think about it that way. But the vast majority of clients, certainly high net worth clients, do not need access to all their capital all the time. And they are leaving money on the table, in our opinion, by not getting the illiquidity premium of tying up some of that money for a period of time. And that's the secret. Investors have figured that out. Financial advisors have figured that out. And that's in part why we have a $5 billion business today and are growing very rapidly on your platform and others. Because clients understand it, they're well educated, and they size their allocation. They're not putting 50% of their money in evergreen funds. They're putting a modest amount. And importantly, where they're often going first is through their IRA. These funds work just like a mutual fund for an IRA. They're very easy. I personally I've had a lot of different jobs. So, you leave, 401k becomes an IRA. I have a pretty substantial 401k IRA, personal IRA. That's what I'm using. That's what I'm putting in there. That's not money I'm planning to touch anytime soon anyway. So what you see is when people first start investing in evergreen funds, if they've got capacity in the IRA, they typically either go there. And all smart investors are sizing their allocation to evergreen funds in a way that they're not worried if we have a mild or even major financial crisis. If the world goes absolutely to heck, all bets are off. But they are sizing this so that they don't need their money in a downturn, and then they're picking up that illiquidity premium. In fact, many of them will invest into that when market prices are depressed. And the private markets, by the way, historically have picked up 115%, private equity specifically, of the upside in markets and only 60% of the downside. So that's a key diversification benefit.
This has just been such a great informative discussion. So we're coming to the end. I'm out of questions. So my last question to you, and I'll start with you, Patrick, and I'll give you last words, Bob. What have we not talked about that you think is important for people to know?
Me personally, I always view we've talked a lot about access. We've talked a lot about private markets and illiquidity, but I really think it's important that people, when they think about how to invest in these markets, they view where we're starting, which is the history goes back to institutional investing. And when you look at institutional investors, they've leaned heavily into the private markets. Either they've had staffs helping them do it, so they were able to pick their own managers, and that's great, and manage their own liquidity. Many were not equipped to do that. Many hired consultants to find the best managers, to figure out that institution's illiquidity budget and manage for it, whether it's vintage diversification or tenor of the loans that they're investing in, to make sure that that institution has the right outcome that they're looking for that's set in their investment policy statement. So when I think about firms, particularly StepStone, when they say they are going to create a evergreen portfolio filled with what their mandate is, which could be infrastructure, it could be venture, it could be private markets, it could be credit, whatever it is, and they say that they have the ability to find and manage the illiquidity and liquidity budgets for it, they have a history going back and doing it for institutions. And so it's really a true entry point for any investor that wants to get exposure to it with sort of no J curve and an immediate exposure to these markets and knowing exactly what you're getting into. It's really a fortunate opportunity that we have to be able to work with some of these institutional investors and consultants.
And Bob, you get last words. What haven't we talked about that you think is important? Or you can really reiterate something.
I think it's important for investors to understand, to do an evergreen fund well, you need two things. First of all, you need a tremendous amount of flow, because not every deal has the right risk-return profile and the right duration to provide the liquidity. So you need a tremendous amount of flow, and you need data tools to interrogate that flow and evaluate when are those companies going to be sold, like when, from a timing, duration point of view, and for how much. And what I believe the real strength of our platform is the fact we are such a large player and we have such refined tools that allow us to do those two things, to take investors' money in on a daily basis in a number of our funds, get it invested so the potential gains are compounding, stay invested, and do that in a format that's convenient, efficient, and transparent. I'd like to leave it there.
Bob, Patrick, I want to thank both of you for joining me here today. It's been such a dynamic and informative conversation.
Thank you. Enjoyed doing it.
Thanks, Marianne. I appreciate it.
And I want to thank all of you for tuning in as well.
Thank you for watching or listening to the Friends of Sanctuary podcast. Tune in next month to be sure not to miss out on the next installment of the series.
Securities offered through Sanctuary Securities, Inc., member FINRA SIPC. Advisory services offered through the SEC Registered Investment Advisors, Sanctuary Advisors LLC, and True Independence. Sanctuary Wealth consists of the wholly owned subsidiaries, Sanctuary Advisors LLC, Sanctuary Securities Inc., and True Independence, as well as Sanctuary Alternative Holdings, Sanctuary Asset Management, Sanctuary Insurance Solutions, Sanctuary Global, and Sanctuary Global Family Office.